Hello and welcome. In this video, we will continue looking at using put options for speculation. In the example in the last video, the trader was bearish on SLV, the silver ETF. However, he did not own any SLV at the time. The price of SLV is $18.62 a share. He bought a put option, giving him the right to sell SLV for $18 a share, and he paid 33 cents up front to do this. If SLV drops below $18 before the contract expires, he can buy SLV at the current price and use his option to sell SLV for $18, making the difference in profit. The $18 put option the trader bought was not his only choice of contracts to buy. Let's look at other contract choices and compare the upfront cost to potential profit and where SLV needs to be for the trade to be profitable. SLV is currently $18.62, and the trader bought a put option which locked in a sell price, which is called the option strike price, for 33 cents a share. He locked in a sell price of $18, and he paid 33 cents up front to do this. Therefore, for the trade to be profitable, SLV must drop to $17.67 or below. So when the trader buys the stock at the current price and sells it for $18, the difference in price that he makes in profit is enough to cover the costs of the option. The put option with the $18 strike price was not his only choice of contracts to buy. For 78 cents a share, the trader can buy a put option with a $19 strike price, locking in the right to sell SLV for $19 a share. In this situation, the trader has locked in the right to sell SLV for $19, and he paid 78 cents a share to do this. Therefore, for this trade to be profitable, SLV has to be $18.22 a share or below. Let's compare the two choices. The put option with the $18 strike price costs 33 cents a share up front, and for the trade to be profitable, SLV must drop to $17.67 or below. The put option with the $19 strike price costs 78 cents a share up front, so the upfront cost for the $19 put option is roughly 2.5 times higher than the upfront cost for the $18 put option. However, for this trade to be profitable, SLV only has to drop to $18.22 or below. More upfront cost, but SLV does not have to move as far for the trade to be profitable. Notice here that the $19 put option locks in the right to sell SLV for a price that is 38 cents above the current price of $18.62. This means that the option has 38 cents of intrinsic value. If SLV did not move in price, when the options expired, the $18 put option would expire worthless, yet the $19 put option would be worth 38 cents a share. The $19 put option costs 78 cents a share, and the current price is $18.62, meaning this option has 38 cents of intrinsic value. But the option doesn't cost 38 cents, it costs 78 cents. The other 40 cents is based mostly on the volatility of price, in other words, how much the stock goes up and down in value each day, and the time remaining until the option expires. If the price of SLV does not move, the intrinsic part of the option's value, the 38 cents, remains constant. However, each day the non-intrinsic part of the option value goes down because there's less time left for the price of SLV to move before the option expires. This is known as time decay. Now let's look at the $18 put option. The current price of SLV is above $18, so this option has no intrinsic value. The value of this option comes only from the fact that the price of SLV moves around, in other words, the volatility, and that there is time left for the price to possibly move to where this option does have value. Because this option has no intrinsic value, each day the shrinking time until the option expires causes the $18 put option to lose more value than the $19 put option. As options get closer to expiring, the more intrinsic value they have, the less time decay causes the options to lose value. We will cover time decay in more detail in a later video. When an option has intrinsic value, in other words, if the lock-in sell price on a put option, also called the strike price, is above the current price like the $19 put option is, the option is considered in the money. If the strike price is below the current price, like the $18 put option is, the option is out of the money. If the strike price is exactly the current price of a stock, like a $10 option for a stock that is currently priced at exactly $10, that option is at the money. Now let's compare 4 SOV put options with different strike prices. The put option with the $20 strike costs $1.53 up front. A locked-in sell price of $20 with an upfront cost of $1.53 means that SOV only needs to drop to $18.47 for the trade to be profitable. SOV is currently $18.62, so for this option to hit money, SOV only needs to drop 15 cents. At $1.53, this option has the highest upfront cost of the 4 examples. However, it is also the most in the money of the 4 options. In other words, the locked-in sell price for this option is the highest of the 4 options, so this option currently has the most intrinsic value. The option costs $1.53, but the locked-in sell price is $1.38 higher than the current price of SLV. The $19 strike price costs 78 cents up front. A locked-in sell price of $19 with an upfront cost of 78 cents means that SLV needs to drop to $18.22 for the trade to be profitable. SLV is currently at $18.62, so for this option to hit money, SLV needs to drop 40 cents. The sell price is $19 and SLV is currently $18.62, so the $19 strike price has 38 cents of intrinsic value. This option is in the money, but not as in the money as the $20 strike. Because this option has less intrinsic value than the $20 strike, each day, as the options get closer to expiring, the value of the $19 strike declines faster than the value of the $20 strike. The $18 strike costs 33 cents up front. A locked-in sell price of $18 with an upfront cost of 33 cents means that SLV needs to drop to $17.67 for the trade to be profitable. SLV is currently $18.62, so for this option to hit money, SLV needs to drop 95 cents. The strike price of $18 is below the current price of $18.62, so this option is out of the money. In other words, this option has no intrinsic value. Because this option has no intrinsic value, each day, as the options get closer to expiring, this option loses value much faster than the $19 or $20 options. The $17 strike price costs just 13 cents up front. A locked-in sell price of $17 with an upfront cost of 13 cents means that SLV needs to drop to $16.87 for the trade to be profitable. SLV is currently $18.62, so for this option to hit money, SLV needs to drop $1.75 in only a month. Because the probability of this occurring is not very high, this option only costs 13 cents up front. The strike price of this option is far below the current price, so this option is also out of the money and has no intrinsic value. So that is looking at different put option contract choices for one asset, SLV, the silver ETF. It is important to remember that this was just a basic introduction. There is much more to selecting an option contract, such as probability of outcome, that should be considered when choosing options. I hope that you enjoyed this video. Thanks for watching. Hello and welcome. In this video, we will continue looking at put option contract choices. In the last video, we looked at options with different strike prices that expire the same month. In this video, we will look at options with the same strike price that expire different months. For this example, I'm using SLV, the silver ETF. At the time of making this video, SLV is $19.42 a share. We will look at the $19 put option that expires each contract month. A SLV put option with a $19 strike price locks in the right to sell SLV for 42 cents below the current price of $19.42. This means this option is out of the money. In other words, it has no intrinsic value. The value of this contract comes only from the fact that the price of SLV moves around, in other words, the volatility, and that there's time left for the price of SLV to possibly move down below $19. Let's look at the costs, also called the premiums, for the SLV $19 put option that expires each contract month, and where SLV needs to be for a profitable trade with each contract. The February $19 SLV put cost 57 cents a share. The locked-in sell price, called the option strike price, is $19, and the option costs 57 cents up front. This means for the option trade to be profitable, SLV must drop to $18.43 or below. This contract expires in about 7 weeks, so for this option to be profitable, SLV must drop to $18.43 or below within the next 7 weeks. The March $19 SLV put costs 79 cents a share. The strike price is $19, and the cost is 79 cents. This means for the trade to be profitable, SLV must drop to $18.21 or below. This contract expires in about 11 weeks, so for the option to be profitable, SLV must drop to $18.21 or below within the next 11 weeks. Let's compare the two. The February contract costs 57 cents, and for the trade to be profitable, SLV must drop to $18.43 or below within the next 7 weeks. The March contract costs 79 cents, and for the trade to be profitable, SLV must drop to $18.21. The March contract costs almost 40% more than the February contract, and for this contract to be profitable, SLV needs to drop 22 cents more than the February contract. But the March contract adds an additional month of time for SLV to move. Let's look at other choices. The April $19 put costs 96 cents, meaning SLV needs to drop to $18.04 by the April expiration date. The July $19 put costs $1.42, meaning SLV needs to drop to $17.58 by the July expiration date, which is roughly 6 months away. The July contract costs 2.5 times as much as the February contract, but the July contract expires in 6 months, and the February contract expires in only 7 weeks. The current price of SLV is $19.42, so with the February put, the price has to drop about $1 in 7 weeks, and with the July put, the price has to drop almost $2, but there's 6 months for it to happen. Looking out further, the October put costs $1.74, meaning SLV needs to drop to $17.26 by the October expiration date. And a $19 put expiring next January, which is about a year away, costs $2.05, meaning SLV has to drop to $16.95 within a year for this trade to be profitable. All 6 put options lock in the right to sell SLV for $19, which is below the current price of SLV, meaning that none of these contracts have any intrinsic value. They have a range of prices from 57 cents for the option that expires in 7 weeks, all the way to $2.05 for the option that expires in a year. The difference in price comes only from the fact that the price of SLV moves around, in other words the volatility, and the fact that there is time left for SLV to move to where the options have intrinsic value. Each day, as the contracts get closer to expiring, the contracts lose money. This is known as time decay. The relationship between the change in time and the price of the option is known as the option's theta. In other words, theta is a measurement of how much the option will change in price when there is a change in the amount of time left until the option expires. We will cover more on theta in later videos. The amount that an option loses in value each day due to time decay is not linear. As an option gets closer to expiring, time decay speeds up. In other words, each day, as an option gets 1 day closer to expiring, the amount of value the option loses each day from time decay increases. For instance, an option that expires in 3 months will lose just 10% of its value from time decay the first month. The second month that triples to losing 30% of its original value, and the final month it loses 60%. An option that expires in 3 months loses 6 times more value from time decay the final month than it loses the first month. So that is looking at other contract months. In the next video, we will continue our discussion on put options with looking at selling a put option to buy stock. I hope you enjoyed this video. Thanks for watching. Hello and welcome. In this video, I show an example of selling a put option to buy stock. For this example, I will use SOV, the silver ETF. At the time of making this video, SOV is currently trading at $18.62 per share. Let's say that a trader wants to buy 1,000 shares of SOV to hold long term. However, this trader only wants to buy SOV if the price of SOV drops to $18 per share, which is the price that he feels is a good price to buy and hold at. One choice would be for the trader to place a limit order for $18 and leave it open. If SOV drops to $18 or below, the order is executed and the trader buys the 1,000 shares for $18 a share as he wanted to do. Another choice would be for the trader to sell 10 $18 put options that expire in 1 month. By doing so, he is agreeing to buy 1,000 shares of SOV from the buyer of the options for $18 per share if SOV should drop to $18 or below. The buyer of the options pays an upfront cost to buy the options called a premium. In this case, the premium is 33 cents a share, or $330 total. The premium varies from stock to stock depending mostly on the stock's volatility. Now let's compare the two choices. Trader A places an open limit order to buy 1,000 shares of SOV for $18, and Trader B sells 10 $18 put options on SOV. Let's say SOV does not drop to $18 or below over the next month. Trader A sits there with his open $18 limit order and nothing happens. However, Trader B sold 10 $18 put options and was paid $330 to do this. Because SOV does not drop to $18 or below, the put options expire worthless and unused, so Trader B simply keeps the $330. For Trader A, nothing has happened the entire month except that he had to leave $18,000 sitting unused in his account waiting for the price of SOV to drop. For Trader B, things are a bit different. He sold 10 $18 put options and was paid $330 to do it. He also has $18,000 sitting in an account as well, but he has made $330 with it, which is almost a 2% return in a month on his $18,000. His money is also sitting unused, waiting to buy the same stock Trader A is waiting to buy. However, he has made a 2% return in a month on that $18,000. Let's say instead that SOV drops to $17.75 a share. The limit order for Trader A is executed, and he buys 1,000 shares of SOV for $18 a share. The put options for Trader B are executed, and he is assigned 1,000 shares of SOV for $18 a share, which is a fancy way of saying that he buys 1,000 shares of SOV for $18 a share from the guy he sold the options to. Now let's compare. It is important to note here that I am leaving off commissions for simplicity. Trader A lets $18,000 sit in an account, then bought the stock for $18,000. With the current price of $17.75 per share, he is down $250. Trader B sold 10 put options and was paid in this example a total of $330 for this. He also bought the stock for $18 a share, but he was paid a total of 33 cents a share up front, so his total net cost is $17.67 per share. He is up $80, while Trader A is down $250. Remember that both traders wanted to buy and hold the stock for $18 per share, and both traders did that. If the stock had never gone below $18 a share, Trader B could keep selling put options each month making money, while Trader A's money just sits in his account unused. Let's say that SOV drops way down in price. Both traders were going to buy SOV at $18 anyways, so both traders are in the same situation. Only Trader B was paid money up front selling puts, so his losses are less than Trader A. Where Trader is going to buy a stock at a set price below the current price, using a put option may be a method to consider. However, it is important to also note that one should only sell put options in this manner if they actually want to purchase the stock. I hope you enjoyed this video. Thanks for watching.